MFS stands for Massachusetts Financial Services. We were established in 1924. We manage approximately $630 billion worth of assets on behalf of clients. We're a global firm. We're a global investment management firm, but headquartered out of Boston, USA. I'd say the investment team are closely aligned with the performance of the fund. They are assessed over a 3- and 5-year period from an outperformance perspective, and even longer if they have a longer track record. And that track record is used to assess the value add to any portfolio that they might touch or are managing. The other part of that is they can qualify for equity within the firm, and if they do qualify for that equity, that vests over a 5-year period. The last piece of the performance rated incentives is around the ability to work with others in the team. So it's very much a teamwork, team culture orientated place. So a big piece of their bonus will be derived by the ability to get on with others and to help their colleagues to deliver alpha for all our clients across the board. The investment objective of the fund is to outperform the MSCI World Index by 3% over a full market cycle. The investment philosophy underlying this strategy is to identify companies that can sustainably grow their earnings faster than the market. What we believe this does is ultimately allows you to compound those earnings over time and therefore deliver that outperformance. The key to all of that, though, is valuation. So making sure you don't pay too much for these names is really, really important. You can best describe this as growth at a reasonable price, or GARP. Stock selection is very much a bottom-up process. We invest in companies, not markets. So we're trying to identify the best companies irrespective of where they're listed and get those into the portfolio. The way we do this is by dividing the world up into 8 different sectors. Our equity analysts, a team of 60+ people, try and identify names to fill the portfolios through their research and bottom-up research in those different sectors. They work very closely with both the credit analysts as well as the quant teams to build these stock ideas. They then work very closely as a team with the portfolio managers to identify the names that best suit those particular portfolios. In the concentrated case, it's trying to identify those companies where we have much more certainty around the earnings outcomes, because if you're going to only have 25 stocks in a portfolio, you need to be pretty certain about the companies you own, because if you make one mistake, that could be very, very painful. So within the concentrated portfolio, which is effectively a subset of the global equity strategy, it's around really trying to identify those companies where we have greater certainty about the earnings and the quality of those businesses that make it into that concentrated portfolio. Well, the key risks are outlined in the PDS, but it is an equity fund, so you are taking on equity risk and you need to be aware and conscious of that. The portfolio itself is quite concentrated, as I mentioned earlier. So if you're only holding 25 stocks, you can look quite different to the benchmark and can perform quite differently to the benchmark at times. The other thing is, as we've been through the process and philosophy, you'll note that it's a high quality kind of process and philosophy. The businesses are definitely high quality. What that means is you tend to underperform in very narrow markets. So if a market has been led by a narrow sector, technology, or it has been led by exuberance, you'll tend to underperform in that kind of environment. Currency is managed in the portfolio at a stock level. We do not manage currency at a portfolio level. The process behind the currency is really to understand the volatility that currency brings to an underlying stock's earnings. So we stress test each company that we own and try and understand exactly what currency fluctuations do to the earnings of that company. If you think about the process as it's been described, you would understand that it's very much around quality names that can compound over time. And where you find those kinds of businesses is typically in the staples sector, typically in healthcare. So we tend to be overweight those 2 sectors. And in healthcare, not necessarily the pharma names, but more the medical technology names. Where you tend to find us being underweight is those sort of cyclical names like mining and metals and energy kind of stocks, and even technology, which are very cyclical kind of businesses, because they battle to control their earnings, or their earnings growth is very strong, but very expensive. The other area where we tend to be underweight is slow growth areas like telcos or financials. Why you would invest in this particular strategy is its unwavering focus and discipline around investing in high quality businesses and strict discipline, as I said, around valuation. That is ultimately the key. And what you get with that is a performance profile which we find most investors appreciate. And that is, when markets are struggling or underperforming, this portfolio typically outperforms because of the quality of those businesses and the quality of the earnings that you own. However, when markets are running hot or exuberant or very narrow, you might find yourself underperforming in those kind of environments. But when you look at that through the cycle and the strength of those companies and the strength of their balance sheets through the cycle, that's when you deliver that outperformance and that compounding effect really starts to come through.